Welcome back to this channel for practice problems for actuarial exams. My name is Krzysztof Ostaszewski. You can find information about me at smarturl.it/Jedi. My advice on how to pass actuarial exams is at smarturl.it/pass. This video channel with practice problems is at smarturl.it/pass actuarial exams. Here you have information about online seminars that I teach for exams P, FM, IFM, and LTAM, and also links to where you can purchase my study manuals for exams P, FM, IFM, and LTAM. I direct the actuarial program at Illinois State University. You can find information about it at smarturl.it/actuary. If you would like to offer a tax-deductible donation to support our students at Illinois State University, please go to smarturl.it/help-ISU-actuary. Here's a problem for today for exam LTAM. This is problem number 4 in written answer section of the last exam LTAM, which was actually the first exam LTAM in October 2018. An insurer issues a special fully discrete whole life insurance of $100,000 to a 60-year-old, under which premium cease when the policyholder reaches age 80. You are given the following assumptions for pricing and reserving. Mortality follows the standard ultimate life table. Commissions are 40% of the first premium, 10% thereafter. Maintenance expenses are $500 at issue and $50 at the beginning of each subsequent year while the policy is in force. Interest rate is 5%, which is the rate used in the standard ultimate life table. Part A. Explain why insurance policies often include a maximum age for paying premiums. Part B. Show that the gross premium calculated using the equivalence principle is $2,790 to the nearest 10. You should calculate the premium to the nearest 0.1. Part 2 of Part B, calculate the gross premium reserve at the end of the second policy year. The insurer holds reserves on a modified net premium reserve basis defined by these rules. The net premium payment term is the same as the gross premium payment term. The first year modified net premium is 50% of the renewal modified net premium. The renewal modified net premiums are level. Part C. Part 1 show that the first year modified net premium using this method is $1,220 to the nearest 10. You should calculate the premium to the nearest 0.1. Part 2, calculate the modified net premium reserve at the end of the second policy year. Part D, Part 1, calculate the first year modified net premium using the full preliminary term FPT method. Part 2, without further calculation, state with reasons whether the FPT reserve at the end of the second policy year will be higher, lower, or the same as the modified net premium reserve in Part C. And here's the solution. For Part A, insurance policies may include a maximum age for paying premiums because the insured may want to have a policy paid in full before reaching advanced age, when ability to earn income declines and often mental facilities fail. The insured is less likely to lapse once the premiums are fully paid, and this may be attractive to both the insurer and the agent who sold the policy. For Part B, using the equivalence principle, we write the actuarial present value of premiums. Say G is the gross premium, contract premium paid over up to 20 years, as long as this 60-year-old is alive, and it pays for the death benefit of $100,000 on the 60-year-old plus 30% of premium for first-year expenses. Now, 40% is the total amount of the expenses, but we split this into 30%. That is a one-time payment, and 10% that happens every year, and that 10% is in 0.1 G A:60:20, plus $450 one-time expense plus 50 every year, including the first one. So 50 times A:60. Or using a standard ultimate life table, we just plug in the values of those. I guess I do want to comment that this percent of premium expense is paid as long as the premium is paid, but the other expense is paid while the policy is running. So that's why it's A:60. So we plug in all those values, and now we can calculate G, solving this equation for G, and G turns out to be approximately 2,787.23403, and this is 2,790 to the nearest 10. For Part 2, the gross premium reserve at the end of the second policy year is calculated as actuarial present value of future benefits plus actuarial present value of future expenses, both percentage of premium, and the fixed one, 50, A.62, because the person is now 62, minus actuarial present value of future premiums, which are only paid for the first 20 years of policy. So for a 62-year-old, for another 18 years, up to 18 years, as long as the person's alive. And if we rewrite this, this becomes 100,000 A62 plus 50 A double dot 62 minus 0.9 G A double dot 62 colon angle 18. A62 is in the table, A double dot 62 is in the table, but A double dot 62 colon angle 18 is not. But A double dot 60 colon angle 20 is, and we write it as 1 plus 1 minus Q60 over 1.05 plus 1 minus Q60 times 1 minus Q61, so 1 minus Q is probability of survival, divided by 1.05 squared times A double dot 62 colon angle 18. And all of the values that we need to have to find A double dot 62 colon angle 18 in this are in the table. So we basically solve this as an equation for A double dot 62 colon angle 18, so that A double dot 62 colon angle 18 is equal to A double dot 60 colon angle 20 times 1.05 squared over 1 minus Q60 times 1 minus Q61 minus 1.05 squared over 1 minus Q60 times 1 minus Q61 minus 1.05 over 1 minus Q61, and we plug in the values from the table and get finally that A double dot 62 colon angle 18 is approximately 11.584928.3. So we plug this all into the formula for the reserve at policy duration 2, and we obtain that reserve to be approximately 3152.13422. For Part C, let us write beta for the renewal modified net premium, and the first year modified net premium is alpha equal to 0.5 beta. So the actuarial present value of death benefit, 100,000 A60, is equal to 0.5 beta plus beta times A60 colon angle 19, which is the same as minus 0.5 beta plus beta A double dot, a 60 colon angle 20. So that beta has to be equal to 100,000 A60 over A double dot 60 colon angle 12 minus 0.5. A60 and A double dot 60 colon angle 12 are in the table. We look them up, plug them in here, solve this, actually just calculate this, and we get beta to be approximately 2,443.105306. The modified premium in the first year is half that amount, so alpha is 1,221.552653. And the modified reserve at policy duration 2 is 100,000 A62 minus, that's a typo, let me correct. So my apologies, that was a typo. It should be minus beta A double dot 62 colon angle 18. So actuarial present value of future benefits minus actuarial present value of future premiums. This is a net reserve, only accounts for benefits and premiums that pay for benefits, and the premium that pays for benefits in the future is beta under the modified premium arrangement. We plug in the values that we have, do the calculation, and we get 3,191.800204. For Part D, we have alpha for preliminary term and pays. That's the premium that pays for 1 year term coverage. That's 100,000 Q60 over 1.05, and Q60 is in the table, SULT table. We plug it in, and we get about approximately 323.619048. The actual present value of future benefits at policy duration 2 is 100,000 A62, so it's 100,000 times 0.3495. regardless of reserving method used. The first-year premium under FPT is 323.619048, while under the modified reserve from Part C, it is 1,221.552653, significantly higher. This also means that the annual renewal premium for FPT is higher than that for modified reserve in Part C. Therefore, at policy duration 2, FPT reserve is lower and modified reserve in Part C is higher. Please remember that this is copyrighted material. The problem itself belongs to the Society of Actuaries. The solution is mine. Good luck in your studies and good luck on the test.